In this video, I'm going to start into Chapter 13. Chapter 13 is on equity valuation, and this continues our study of fundamental analysis. So in Chapter 12, we started top-down fundamental analysis. We looked at macroeconomic indicators, and then we came down to industry-level ideas and concepts. In this chapter, we're going to drop all the way down to the level of an individual company, and we're going to look at fundamental analysis methods of valuing that company. Okay, so in particular, again, we're talking about fundamental analysis, and the main goal here at the level of a company is to try to identify stocks that are mispriced relative to some measure of intrinsic value. This term, intrinsic value, this is an important term. What does this mean? You're going to see our notion of intrinsic value is sort of like the idea of a true value. Okay, like what is the true value of this company? And the idea is that it might be different than the market value. Okay, so that's our idea here. Every time you hear the word intrinsic value, think of sort of my notion of what should be the true value of this company. And that's something that we're going to calculate. Okay, the standard approach to calculate the intrinsic value is as the present value of the cash flow stream that an investor receives. This is very much a finance perspective. From a finance perspective, any investment, doesn't matter whether you are investing in the stock of a company or investing in something else, how do you value that? Well, you map out the cash flow stream that you would receive, and you calculate the present value of that. So that's going to be our approach here. All right. Moreover, what I'm going to focus on here is I'm going to focus on very simple models. So we're going to start at the very beginning. And these models will, in some sense, be overly simplistic. Okay, but they are actually the building blocks for more complicated models later. We won't cover that. Those are things that would be covered in perhaps more advanced courses. But I'm going to introduce you to the ideas. And then with the simple models, I'm going to show you that you can still get some insight out of these very, very simple models. So that's what I'm going to focus on here. I'm going to cover the first section on dividend discount models in this video. So let's dive right into that. And these are, like I said, the simplest models, but these are really, think of them as building blocks for more complicated models. All right, let's jump into dividend discount models. And again, our goal here is to try to calculate intrinsic value. Intrinsic value meaning my notion of what should be the true value of a company. And then if that differs from the market value, maybe there's a trading opportunity. All right, so from this perspective, dividends are the cash flow stream that an investor receives. Like I said, our perspective is that what is the value of an investment? You look at the cash flow stream that you would receive, and you basically discount that or calculate the present value of that. If I'm investing in a company and I'm just going to hold that company forever, I'm never going to sell it, and I think about it for a while, what is the cash flow stream that I would actually receive? The only explicit cash flow stream are the dividends, okay? So in this model, we start from that perspective, very strict perspective. I hold a stock, I'm gonna hold it forever. The only thing I'm gonna receive are the dividends. So I'm gonna look at those dividends. I'm gonna calculate the present value of them. That is, I'm gonna discount them back at some appropriate discount rate. And that's gonna tell me the true value, what we call the intrinsic value, or what I believe should be the true value of the company. All right, so that's the idea here. What does it look like in terms of a picture? Here's my cash flow stream. Here's time. Again, this is my cash flow stream. And I'm sitting here at time zero, and I'm looking at buying this company. And if I buy it, what's going to happen? A year goes by, I'm going to get paid a dividend. Another year, I'm going to get paid another dividend, etc. And that's going to go on. And I'm going to hold this thing all the way out to infinity. So that's what my cash flow stream looks like. Looks like a cash flow stream all the way out to infinity. From this perspective, then, what should be the true value or the intrinsic value of this investment? Well, what I would do is I would say, hey, these are the dividends that I'm going to receive at these times, and I'm going to calculate their present value. And that's it, that present value. That's going to tell me the appropriate price at time zero, and there's my intrinsic value. So that's our idea. Keep that in mind. That's all we're doing here is calculating present value. Now, this is not a risk-free cash flow stream. So this is a cash flow stream coming from a company That's risky, so we're also going to have to consider what would be an appropriate discount rate to use when I'm calculating present value. So let's talk about that. So again, this model, the simplest model, projects all the way to infinity. And in particular, when I calculate this present value, I need a discount rate. So we're going to call our discount rate the market capitalization rate. That's the term that we're going to use here, and I'll use that throughout this chapter. This is commonly actually taken to be the CAPM. Okay, why is that? If I'm receiving dividends, I'm an equity holder. I've just purchased shares of stock. And CAPM is our theory that says, hey, if you invest in something risky, if you invest in a stock, here's a reasonable rate of return for that. Let me remind you of the CAPM. The CAPM says, what is a reasonable expected return for a stock? CAPM says here, I've got a formula for that, risk-free rate plus the beta of the stock multiplied by the market risk premium. Okay, so even though we're going to call it what? The market capitalization rate, throughout this lecture and throughout this chapter, it's fine if you think of it as, oh, that's the CAPM rate of return. Okay, so go ahead and put that in your mind right now. Market capitalization rate, CAPM rate of return. Again, that's our notion of that should be a reasonable, at least according to CAPM, that's a reasonable rate of return for a stock like this. We are going to call it K. So we're going to denote this discount rate by K. Again, think of that as coming from CAPM. Okay, so that is going to be the rate of return that we use in all our present value calculations. All right. So let's see how this works. There's our sort of big picture perspective. I'm going to receive these dividends. I need to calculate their present value. I need an interest rate or a discount rate when calculating present value. We're going to call that discount rate K, assume that it comes from CAPM. However, this is still a little too complicated because why? Oh, I don't know what these dividends are, right? That's pretty tough. I not only have to model these dividends, I have to model them all the way to infinity, okay? So, that's complicated. I don't know what a stock, what its dividends are going to be all the way out to infinity. So we're going to simplify, and we're going to use the following. We're going to use a constant growth dividend model, and this is often called the Gordon growth model, okay? So it's a simplification. Here's what it looks like. Let's project dividends all the way to infinity. What does that look like? So here were our dividends going all the way to infinity, but we said, hey, that's complicated. Let's simplify. So this would be difficult. So to simplify, we're going to assume a constant growth dividend model. What does that mean? Start over here on this side. If I tell you the dividend amount at time I, maybe time I is time 1, okay? Then it says the dividend amount a year later is just G more, right? It just grows by a rate of G from the dividend at the previous time. So G here is our growth rate. And this is the growth rate of dividends. So it might be something like 5%. You're assuming that every year the dividends grow 5%. They're 5% higher every single year. Okay, so that's our model, and we're going to assume that's constant and never changes. Now, that's an oversimplification. A lot of things in this model are an oversimplification. For example, many stocks do not pay a dividend. So it's like, how would I apply this model if stocks don't pay a dividend? So there you would have a very, very difficult time using this model, right? It's just not appropriate. So this model, it's very simple, and we like its simplicity, but we recognize right off the bat that it doesn't apply to everything. Only in the case of a stock that already pays a dividend, and we assume that that dividend is going to grow at a constant rate for a long, long time, right? Our theory is out to infinity. Okay, so note that this model does not apply to everything. It's a very specialized and stylized model, but you'll see why we start with it, because we get a very simple formula for the intrinsic value or the present value. Let's see how that works out. Okay, so here's my model, and I'm assuming that these dividends are going to grow, constant growth at a rate of G. So if D1 is my dividend at time 1, then the next year it's going to be 1 plus G, right? It's just grown at a rate of G over the year. And then the next year, that gets multiplied once again by 1 plus G, so I'd get 1 plus G squared. etc. And that's going to go on all the way to infinity. So again, G is that growth rate, could be something like 5%. I assume the dividend's going to be 5% higher every single year forever. Okay. To value this, what do we have to do? I said our perspective is we just calculate the present value of this cash flow stream. We're going to calculate the present value using what as the discount rate? We're going to use the market cap rate. I called that K. And I said, remember, that just comes from CAPM. Okay, so that's what we're going to use. So if we use that and I calculate the present value, here's what I get. So essentially, I'm pulling these back here, present value. And if I do that, that gives me my intrinsic value for this company. That's what we're going to call that. It's what I believe should be the true value. And we have a super simple formula here. This formula, we're going to call this the Gordon growth model or the constant growth dividend model. This says the following: I can calculate that present value or the intrinsic value of this company as D1 over K minus G. Now you might wonder, how did I get this? How did I get this formula? It's very, very simple. And that's what we like about it. Here's how I got it. Let me show you that this is very, very similar to a formula that you've probably seen before. And that's if I assume that the growth rate is 0. Then the model here is I receive D1 every single year, and this is D1, D1, all the way out to infinity. So I receive exactly the same amount forever. And if you remember, maybe from one of your other classes, that's called a perpetuity. You receive the same amount every year forever. And you might also remember that there's a formula for the present value of a perpetuity. And that formula, in this context, it would have been D1 over K, where K is the discount rate. But we have essentially a growing perpetuity, and it turns out all you have to do is modify this by D1 over K minus G, and that's the correct formula. So that's where it comes from. Okay, so very nice. We've got a really simple formula now. That's why we like this, because then I can look at parameters and I can intuitively understand sort of what's going on. So let's dive into this a little bit. A couple of things to note. First, like I said, this model is a very specialized, stylized model. So it only applies in certain circumstances. What are those? A company that pays a dividend and that you believe is going to grow its dividend at a very steady, constant rate. That's what we're calling G. If you're looking at companies that don't pay a dividend, or that you think their dividend amount would be going up or down a lot over time and it's hard to predict, you should not be using this model. Other things about this model. One of them is, remember, the market capitalization rate. Remember, that was our discount rate. That actually must be greater than the growth rate for this model to make sense. Otherwise, it makes no sense. If it's not, you're going to get a negative number here. The whole thing is negative. It just doesn't make sense at all. Okay, so you must assume a market capitalization rate greater than the growth rate for this model to make sense. Right? And then when you have a model like this, you also begin to question things like, well, what is a reasonable growth rate? I have to assume that this stock is going to grow forever. What's a reasonable rate to assume that a stock can grow at forever? And that you can begin to think about that, and you'll probably come up with things like, well, the growth rate shouldn't be greater than the growth rate of the overall economy, right? Because if a company can grow faster than the overall economy forever, it will eventually become the overall economy. So there are sort of sanity checks that you can do with a model like this to try to get reasonable parameters into it. I won't focus a lot on that here. You do need to know that the market capitalization rate must be greater than the growth rate. Otherwise, this model is not applicable. Okay, let's move on and let's analyze this model a little bit. Why do we like it? Because we have such a simple formula, and now we can intuitively understand what is driving this intrinsic value. Let's take a look at that. So here's our model, and a couple of quick things that we can note. Number one, we see that the value of a company is increasing with what? Increasing value of the dividend D, okay? That just makes sense. D is right up here. As D goes up, the price should go up, right? A company that pays a higher dividend, everything else being same, should be worth more. Very, very reasonable. Second one, increasing value of the dividend growth rate, G, okay? So this one just says, as G goes up, the value of the company should go up as well. this also makes sense, right? Because if a company can grow faster, it should be worth more, right? Because it can grow to be a bigger company. How do we see that in the formula? As G gets larger, we're subtracting off G. That makes the denominator smaller. That makes the value larger. Okay, so you got to go through those steps, but it's basically corresponds to our intuition. Faster you can grow, the more valuable you should be. And then the last one here, a company is increasing actually with decreasing value of the market cap rate, K. So the market cap rate, remember, that's our discount rate. And this says the lower the discount rate, the higher the value of the company. Or maybe it's good to think about it the other way around. The higher the value of K, the lower the value of the company. Let's think about that. K, I said, came from CAPM. And so I'm going to write the CAPM prediction again. And K coming from CAPM, let's see, if K is larger, K goes up. How could K go up? Well, the only thing over here that depends on the company is beta. So if K goes up, what does that mean? Beta was larger. Beta represents what? Market risk. So this means a company is riskier. And if a company is riskier, everything else being equal, right? To get you to invest in something that's risky, you're going to have to give me a good deal, or you're going to have to lower the price. So that's what this would correspond to. If the market capitalization rate goes up, meaning the company is riskier, the price should go down. If the market capitalization rate goes down, the company is less risky, the price should go up, everything else being equal. Okay, so it allows us to look, this simple model allows us to look at those parameters and see how they affect value. Let's go a little bit further, okay? And let's think about if you're an investor and you invest in the stock, then according to the Gordon growth model or the constant growth dividend model, there are basically two ways over a year that you're going to make money. So the first one is you're going to receive that dividend. We said the dividend drives everything in this model, right? It's all based on that dividend. We're just calculating the present value of the dividend cash flow stream. So very important is that dividend yield. What is a dividend yield? It's just the dividend expressed as a percentage of the price. So the dividend yield is tell me the dividend and divide it by how much I paid for that. So that might be something like, 3% or 4%, whatever it is. That's the amount that you get from the dividend. So that's one way you're going to make money. You buy the stock, you hold it every year, it pays you that dividend. Okay. What is the other way that you would potentially make money from holding the stock? The other is hopefully the price will go up of the stock. Even if you don't sell the stock, you want to see that price going up over time. So it turns out in this model that we have the following property. The growth rate of the stock price, that is, we expect the stock price to be going up every year, is actually going to be equal to the assumed growth rate of the dividends G. What does that mean? In this model, you have to assume that the dividends are growing at some rate. Maybe I assume they're growing at 8%. If I do that, it turns out in this model that flows through to the price, and the price will also be going up at 8%. So whatever you assume for the dividends, that's because the dividends drive everything in this model. Turns out that is also the same growth rate that you expect to see in the price. So remember that. Whatever you choose as this growth rate for the dividends, you expect to see that in the price as well. These are your sort of two sources of income, or your rate of return. If you buy a stock, you're going to get that dividend, and then hopefully the price is going up. And so we can write this as a simple formula. The total return, or you could say the holding period return over a year, that an investor expects to receive is what? The dividend yield, we said that was the dividend yield there, plus the capital gain growth. That is the growth in the price. We just said that was G. Okay, so remember this formula. All right, these are the basic properties. Let's do a problem on this that has a couple of parts to it. Here's our problem. IBX's stock dividend at the end of the year is expected to be $2.15. It is expected to grow at 11.2% per year forever. If the required rate of return on IBX's stock is 15.2% per year, what is its intrinsic value? Let's make sure we understand the terminology here. Okay, so the first is that we're told the dividend at the end of the first year, that's what we've been calling D1. And it's expected to grow at 11.2% per year. That was what we call G. Now we come to this. If the required rate of return on IBX's stock is 15.2, what are they telling us there? Required rate of return. We haven't seen that terminology before. This is actually the market capitalization rate. Okay, so what did I say the market capitalization rate represented? It's sort of what's a reasonable rate of return for this stock. And we're taking that reasonable to be, in most cases, to come from CAPM. So again, I said think of market capitalization rate, at least in the context of this chapter that we're going through, as coming from CAPM. And that's sort of what is, according to CAPM is reasonable, or you might say that's what the market expects out of this stock. Or another way to say that is the required rate of return. This is what investors would require, or what investors would want to see. And we're assuming that investors look at that stock and they say, hey, it should line up with CAPM. So that's why investors would expect to see that, or that's the rate of return that they would like to get. So watch for this terminology. If you see something like required rate of return, or say investors expect this rate of return, the market thinks this is a reasonable rate of return, they are telling you what K, the market cap rate. Okay, so good. Hopefully we've got that down. And then finally, here it wants us to calculate the intrinsic value. Again, intrinsic value, that's our term for what we believe should be sort of the true value of the stock. And where are we getting that? We're getting that from our models where we calculate the present value. Okay, take a crack at this problem. I'm going to show the answer right now. So there were our parameters, D1, G, and K. And this first part just says intrinsic value. And now we've got the Gordon growth model, right, or the constant growth dividend model. And that says, hey, you want to calculate the present value or the intrinsic value of this. It was this following formula, D1 over K minus G. D1, $2.15. K, that's the market cap rate, 15.2. And a growth rate of 11.2. We plug that in and I get $53.75. Okay, pretty straightforward. Once I identify those parameters, plug into the Gordon growth model, and I've got the answer. Let's move on to the next part of this. Let's remember $53.75. That is our intrinsic value at time zero. Next part, if IBX's current market price is equal to the intrinsic value, we just said that was $53.75, so I'm going to write that right there. What is next year's expected price? Again, I'm going to reveal the answer. According to our model, according to the Gordon growth model, the increase in price was equal to what? Was equal to the dividend growth rate. That was that property that I mentioned. Whatever you assume for the dividend growth rate, you're actually also assuming that for the price, or that actually flows through to the price. So we're assuming the dividends are going to grow by 11.2%. So that means we also expect the price to grow by 11.2%. So what do I need to do? I just need to take this $53.75 and increase it by 11.2%. Well, let's do that. So this says the price at time 1 should be the price at time 0, just multiplied by 1 plus G. Okay, and I wrote this out here in terms of the Gordon growth model. I didn't need to do that. So here, price at time 0, we calculated that. I'm just going to increase it by 11.2%. So that's 1 plus 11.2%, and I would get $59.77. So there you go. Under this model, next year, I actually expect that the price has gone up to $59.77. Okay, good. Let's do the last part of this problem. If an investor were to buy IBX stock now and sell it after receiving the $2.15 dividend a year from now, what is the expected capital gain? That is the price appreciation in percentage terms. What is the dividend yield? And what would be the holding period return? Okay, so this goes back a couple of slides where I showed you the total return in a year, or you could call that the holding period return in a year, was made up of two different parts. What were those parts? The dividend yield and the capital gain yield, or the price going up. Okay, so that's what this problem is about. Let me reveal the answer here. So let's break it down. Recall that the expected return, or the total holding period return, is equal to the dividend yield plus the capital gain yield. So for the Gordon growth model, we had the following. The capital gain yield, that is the price appreciation, how much we expected the price to go up. We said that was equal to whatever you assumed for the dividend. That was 11.2%. In fact, that related to the previous part of the problem. Okay, so we've got that. Then we also get the dividend. So what is the dividend yield? $2.15. How much did we pay for this stock? $53.75. We got that from the first part of this problem. That represents a 4% rate of return. So the overall rate of return to the investor is what? Just the sum of these two. Total holding period return is the dividend yield plus the capital gain growth, or the price, how much we expect the price to go up. Add those together, 4% dividend yield, 11.2% price increase that we expect. Add those together, and we get 15.2%. That would be our total holding period expected return. Okay, so that ran through some of the basic properties of the Gordon growth model, or the constant growth dividend model. All right, that's it for the first section.